one of the things we always say is that like a plan is a living document. We revisit it yearly. But sometimes there's adjustments or there's changes or there's things that are in the plan in people's heads that they don't tell us about.
Welcome back to Money Talks Life Lessons. I'm Joanne, Kaban, co-founder of IO Wealth of Raymond James, and today I'm joined by my business partner extraordinaire, Melissa Maguire.
Hello.
So today, Melissa, we are asking all the questions that a lot of people want to ask their advisors, but are maybe too hesitant to actually say it out loud.
Why do you think that is? Like, why do you think that people are so hesitant to ask like certain questions, like the examples we're bringing forward here, like about their money when they go see their advisors? That's where we're supposed to sort of lay it all out on the table, but people seem to be really hesitant to ask these questions, even when things are going well.
I think maybe it's just around they don't want to look like they don't know the answer, right? There might be a lack of knowledge there. And, you know, for myself, sometimes I'm afraid of, you know, not looking smart enough, right? Or thinking that it's a dumb question. I think that's the famous one we always hear is, this might be a stupid question, right? We get this all the time.
Yeah.
And I know our answer is there is no such thing as stupid questions, because in our role, our job is to educate clients and to make them feel comfortable enough to ask us these questions, right? Because that's the only way we're all going to learn.
No, I completely agree. And I think that, I mean, I say this all the time from, you know, back in the day when I was a lender, that if you bring up numbers, a lot of the times people might they know a lot of stuff about a lot of things and they might know a lot about numbers, but you bring up numbers and suddenly people start glazing over and the fear sets in and whatever. And I think that might really, you know, help the process of not asking the questions, because it just sort of gets to be overwhelming and scary sometimes.
So let's get into it. Let's ask some of these questions and kind of talk through the answers.
Okay. Sounds good.
For our listeners. Okay. So the first one, am I actually on track for the lifestyle I want?
We get that one a lot.
We do. Yeah.
What do we think that they're really asking? Do we think that they're asking if they're going to live on a sailboat, or if they're going to be able to eat weekly, or if they're going to have to eat cat food? Like, what do we really think that they're getting to?
I think for a lot of people, like even if they're doing well in the markets, like from an investing standpoint, they want to make sure that the rug's not going to be pulled out from under them. I think they're trying to anticipate what might come up, what might derail the plan, right? And so I think from our side of the things, that's where it's really important that we have a plan and we connect everything to that plan, right? To be able to reiterate that they're okay. Because what a lot of people don't realize is as planners, we budget for downturns in the market. Right. We get calls all the time now with, especially since we have a certain president in the United States being in office, asked about, okay, well, are we going to go into a major recession? And should I go to cash, or what should I do from an investing standpoint? Because they're concerned that everything that they've worked towards is just going to go disappear. Right. But we plan on market corrections. That's exactly what we do when we make assumptions, is we make sure that, you know, if we're assuming I'm going to pick a number, 5% rate of return, for example, and most of our clients do much better than that, right? So that little bit of a top up acts as a buffer for what we're looking to do, right?
It's the adage that we say all the time in this industry of plan first, invest second.
Yeah, exactly.
Yeah.
So yeah, we're talking about people meeting their retirement plan or whatever that goal might be, but lifestyle expectation plays a big role in that. Can you elaborate on what that might look like?
I guess it's like one of the things we always say is that like a plan is a living document. We revisit it yearly. But sometimes there's adjustments or there's changes or there's things that are in the plan in people's heads that they don't tell us about.
Right.
So like, for example, there might be an expectation that they'll be, you know, giving their kids a down payment for the house, or they plan to live on a cruise ship in their retirement years. Like those sorts of things that maybe we've had like a fulsome conversation about everything, but things are changing in the background and then we don't know that. And so as we're working and we're budgeting for market downturns, we're budgeting for stuff, just the same way we can budget for, big monetary expenses that are needed. If we don't know, if we just haven't had that sort of communication about it, then sometimes it can be a little bit of a surprise and we'll have to sort of work through it. But if it's a total surprise and it's something that just brand new comes up, then that could be, it can be a bit of an issue or a surprise. Sometimes I find too also, like health things can come up that can maybe weren't planned for or thought about initially. And it doesn't necessarily mean just people who are retired. Like health things can come up, marital things can come up, all those sorts of things that adjust or change a plan. But if we don't necessarily know how to do that because we just haven't had that
Conversation
on both sides, then that could be a bit of a surprise.
And I guess in regards to that, we have to kind of adjust expectations. And I think some people are afraid to tell us that they want to travel around the world.
Right.
Because they've all of a sudden decided, hey, I really want to go on this cruise and then maybe I want to go here and there. And they know it's going to cost a lot of money, but maybe they don't necessarily have enough to do that. Right. So I think sometimes there's a little bit of a hesitation on having that conversation because maybe the clients have these dreams that they want to fulfill, but they also don't know what that's going to mean when they get back home and they have to live out another 20 plus years. Right. So I think it just comes down to, having an advisor that you feel comfortable talking through these scenarios. And if they're the right fit for you, they should be saying, okay, like at the end of the day, this is your decision, but let us show you, how we can make this work or what the repercussions will be if you do this or not. And in some cases, like a lot of the times you and I, we both are encouraging people to spend their money because they often are more fearful to do so.
Yeah, exactly.
But then we've also seen the other side where people, will be so excited to travel and then they don't have any type of reserve left when they get home. Right. So it's just finding a balance and making sure, that people have the confidence to talk to that advisor so that we can walk through all scenarios so they're prepared.
And I think that you sort of hit on the main point here that it is a personal conversation with your advisor.
Right.
So, am I on track for the lifestyle I want? Is the lifestyle I want, not somebody else's lifestyle. It's not comparing to somebody else's lifestyle. It's for what you want. And it's a very personal thing, which can be a really tricky thing to bring up to your advisor sometimes, especially if you're just sort of in the getting to know each other stage.
Exactly. So let's talk through the next question. And this is a fitting question for the day and age we're in right now. Is it okay that we still have debt? Most people never want to talk about their liabilities in our appointments.
Never, ever. It's like, I mean, it depends on where the debt came from, what the plan is, what their thought is for the debt. It's a very personal sort of question, and we have to sort of discern what the debt is, right? Is the debt there because you're overspending, or is the debt there because you have a mortgage? And a mortgage debt is very different, and lots of people go into retirement with mortgages these days, maybe more so than ever before. But is that necessarily like a bad thing? It's very, very personal to everybody. I would say that, in general, it's okay if there's debt as long as the debt's not controlling you. Right. So, and by that, I mean, like if your retirement income is going to pay a debt and then you just spend back into it the next month, and sort of like a revolving credit card, and you're not really getting very far and it's costing you more money than it's helping you with. And maybe I would say part of the plan might be looking at how we can reduce some of that, maybe do some budgeting, maybe do some whatever. And quite frankly, we do see this all the time, or have in the past anyway, seen it all the time, where the first couple of years of retirement, it's like a very like strong need for a budget in the first couple of years, because people are just sort of settling in and figuring it out. If they started planning ahead of time for these things, then maybe, once they hit retirement, it's a little bit more of a smoother sailing. But if they just start thinking about it, and then there's this massive adjustment to income and lifestyle and everything, then sometimes that's where we can see the debt start to creep up. And then in which case, I would say that debt is maybe less comfortable. But again, it's one of those very specific things. People might view using a home equity line of credit very differently for different purchases, or like a supplement to their income,
Right.
or something to that effect. It's not always bad. These days, we see a lot of people doing reverse mortgages, right?
Mm-hmm.
That is a debt against a home, right? But it's not necessarily a bad thing. It depends on the situation and, the person.
You know, a lot of times people will feel like debt is almost like a confession of a wrongdoing, right?
Yeah,
Because, a lot of generations before us grew up with, you should not have debt, right? Like that's the most common thing we hear about people going to retirement. I have to pay off my house. So they'll be so prioritized on paying off that mortgage versus maybe saving into an investment plan because they don't want to have debt. It's almost like it's a sin, right?
Right.
And so this is where I think there's a mindset shift that's starting to happen, is trying to figure out, okay, there's two types of debt. One is a strategic debt, and then another one is kind of like emotional, like an emotional tie to debt, right?
Right.
And so I know we always joke about this and we talk about Monopoly because that's like such a fun game, like I grew up playing, and I feel like that really helped me learn at a young age about debt, right? Mortgaging, because one of my strategies, and I'm going to share this out for the whole world to hear now,
Do we get
which
to hear your Monopoly
I know they're going to hear my
strategies?
Monopoly strategies, which I keep like locked up. But personally, for me growing up, I would always leverage my properties in order to get more money sooner to get ahead of other people.
Right,
And so that was a strategy I've always used. And most of the time it has served me well for actually winning the game. And so it's a conversation I have with my son quite a bit about this. And he's actually doing a very similar strategy when we play as well. So I don't like it because he's keeping up with mom, but I'm also proud, right? But it's one of those things where sometimes debt can be a strategy. But then sometimes, like you said, it can be a handcuff. So it's just really understanding why you're using it. And so for some people going into retirement, their house is going to be the best asset they have, right? They have a lot of equity in it. In major places like Vancouver, Toronto, Victoria, properties are millions of dollars, right? And if you want to have a certain lifestyle, and maybe you're not as concerned about leaving millions of dollars to your kids, you're going to leave them something, or maybe you don't have children, you want a way to access that equity.
Right.
So that's where home equity lines, or you've talked about reverse mortgages and mortgages, can actually be really beneficial for people being able to live the life that they want to in retirement, right? So I think it really, don't be afraid. I guess my tip is, don't be afraid to talk to your advisor about debt, because, we're aware of even the need for it at times, right? And we're there to kind of talk through efficient ways to make whatever you're trying to achieve, right, a reality. And sometimes that means having debt, right? But we're going to help work through that and figure out a plan for paying it off if you're feeling handcuffed, or taking advantage of it if it makes sense.
So kind of like what you alluded to earlier, debt is no longer considered a character flaw. Right? It was before, maybe. But now it's not, as you said, strategic, or maybe not strategic, but it's not a character flaw, and it does need to be talked about.
Exactly. It's it's a big part of your financial situation. If you're paying thousands of dollars onto the credit card every month and living month to month, we have to address that, right? There's obviously some sort of lifestyle things going on, and it can be quite eye-opening if you review your credit card statement at the end of the month. Like we've done this with clients before, and they're realizing, oh my goodness, I go to Starbucks every single day. And that adds up pretty quickly, right? So, and you don't even think about it. You're just doing the actions. But then next thing you know, you're spending $100 to $200 a month on Starbucks, right? So it's just being aware of what's going on. And maybe you have enough money to do that. Maybe you don't, right?
Right. What about those families that have, they have debt due to investment properties or businesses, or, those sorts of things? How would you characterize that?
Yeah. And to me, I see that as being very strategic, right? Because if we think about it, we are actually allowed right now, things could change, to write off interest on investment properties. So you're going to see a lot of really successful families taking advantage of that. So even when we have conversations with clients today about who have rental properties and structuring their mortgages, we always try to have a larger mortgage on the rental on the rental property, so there's tax deductibility there versus on the primary residence, because then there's not. You're living in it, you're using it yourself, right? So it's just about figuring out where are you going to get the most benefit, because if you're having a rental property and renting it out for X amount of dollars per month, that's that's profit, that's income for you. So we try to keep your expenses in line with the income you're generating,
right?
If it makes sense, right? To try to reduce the amount of taxes you're going to pay in a legal way, of course. Put my compliance hat
I love
on.
how we always have to say that.
Yeah. And so that's one of the things that we try to strategize on too. So in this type of scenario, having debt can be a really efficient strategy on reducing taxes. And it might even be something that we would recommend versus just having a stream of income coming in, depending on what your tax bracket is and what tax situation you're in. So it's just one of those things where there's a place and a time for it.
Yep. And back to the debt does not equal a character flaw.
Exactly.
Okay, so the next question that we hear a lot of, and I'll ask you this time, is are we invested properly for this stage of life?
Yeah, we get that a lot as people are approaching retirement, right?
Yep.
Or even in retirement. I think it just depends on everyone's personal circumstances. I know everyone hates hearing that when they're listening to a podcast.
Yeah.
It depends on the situation.
Yeah.
But it really does, because at the end of the day, some people have money invested that they're never going to use, right? They know it's going to be a generational transfer of wealth. And when we have those conversations, it's like, you know what? Let's have it still grow so that the next generation can profit from that, right? Because they're not going to tap into it. So they can handle fluctuations in the market. Whereas then we're seeing people in retirement who are thinking, okay, I'll leave something to my family if there's anything left. But ideally, we're going to need to rely on this for an income stream, right? So in that situation, we are going to have more of a balance, right? We need some downside protection. We need to make sure they have 2 to 3 years worth of income at their fingertips in case we have a COVID situation, right? So I think it really is dependent on where they're at in their life stage and their goals. But we are happy to answer that question and really get down to it so that you're not feeling like you're losing sleep at night over this, right? I think that's our goal.
So if we think of, it from the perspective of bonds and equities, let's just say, so we think of that downside protection, we think of the ability to draw a dividend, we sort of put those two together. How does an understanding of risk play into those questions when we're considering the overall question of, are we invested properly for the stage of life? Like, it used to be the old adage of, as you hit your retirement, you sort of flood into the safety sections.
Right.
Is that doing what we need it to do these days? Are we looking at risk differently? How would you approach that question?
Yeah, I think we have to, we have to start assessing the economic times we're in, right? We are in high inflationary period, right? Costs of goods are a lot more money. So gone are the old days where you could say, I'm going to put it in a GIC, or I'm going to buy a government savings bond, right? Or a Canada savings bond, and earning 3% is enough. For a lot of people, that's not enough, right? I mean, we kind of have to earn 3% just to meet inflation these days, right? So, and then a lot of people want growth on top of that. So I think it's going to come down to either financial plan, figuring out, okay, what rate of return do you need to support your income stream? And then we're going to have to take into account inflation. So risk is a kind of a loaded question, right? Because people think, risk of market volatility, but there's also the risk that your money's not making enough money to support your lifestyle.
Exactly.
Right?
Exactly.
So we have to be careful about that. So with saying that, how often should we be revisiting a risk profile with clients? Like, is that something that we should be doing?
Oh, I think so.
Yeah.
Like, I do think so. Like, I think that depending on sort of a structure, at the barest of bare minimums, people should be reviewing their portfolios like yearly at the barest of minimums, right? And as you review your portfolios, then we should be sort of linking that back to your plan and linking that back to your ability to withstand risk. And I'm not saying we go through the whole questionnaire on risk every single year. We should be doing it every couple of years for sure, because things change. But I think that it can be a conversation that's brought in to a comfort level when, things are being reviewed regularly.
Right. I think that old additive that set it and forget it for most people never works. Right.
Right.
Yeah. It's great in theory, but
Mhm.
putting it into play, it's very hard for people to do that. And a lot of the times, as you were just mentioning, things change and evolve. So we need to evolve with them. Right.
Right. And I find that, like, if we consider risk tolerance changes with what's going on in the markets.
Yeah.
Right. The markets are great. They don't worry about risk so much anymore. They think they might have a whole different risk tolerance than they did, 2 years ago when maybe markets weren't so great.
All of a sudden, they want to make more money.
Exactly. I'm making up time frames here, by the way, but and then when the markets are not so great, then we really get an idea of what people's risk tolerance it really, really can be. And it's that part of the conversation that needs to be talked about all the time. Because if we might have, like, let's say at a review, they might be like, oh, that's great. I've made 14% this year, but how are we going to get it to 20? And so in the back of my mind, I'm like, how are you going to keep it at above 5? If we have a downturn in the market, what are we going to do here? How are you going to be? Are you going to be okay with that? So definitely things change in people's lives for sure, but sort of economic conditions, market conditions change, definitely how people see risk. And
Right.
if it's good for people. And if it's not so great, people then very quickly remember, how they really feel about risk.
So some people might say, more risk equals more success. But in our lens, that's not necessarily the case, right?
Exactly.
Yeah,
Exactly.
because all of a sudden, you everything's good while the markets are good. But then soon as we get any type of volatility, that's when we can see what people can truly tolerate. And if you're selling at the bottom of a market, that does not equal more success. So it's just about finding that balance for people, right?
Exactly.
So bringing it back to the question, are we invested properly for this stage of life? I really think that it's just something that we need to be addressing with clients. Every time we review what's new, what's changed. And so for those clients that are maybe a little bit apprehensive to ask their advisor this, please do, because it's very important. Everybody's favorite question and topic, Melissa, is tax.
Right.
So the next question is, are we paying more tax than we need to? Thoughts?
Well, I would generally say yes. But are we paying more tax than we legally need to? I don't know. I don't know the answer to that. Again, it's one of those sort of individual things. But what we always should be doing is looking at how we can be as efficient as possible, right? With your portfolio. There's always, like, one of the things that you used to say back in the day is asset allocation and asset location, right? Are we using these accounts the right way for the right tax efficiency so that, you get to keep more of your money, knowing that we have to pay taxes on everything else out there anyway.
Why do you think tax feels so intimidating for people to talk about?
Oh, I suspect first is numbers, right? And people just tend to, get a little bit nervous around the numbers. I mean, depending on really what we want to hear on this podcast, it could be like a whole, like, government involved in my business sort of issue, right? Because you've got to report everything to, the government and then pay them if you haven't paid them enough, right? It's a lack of control, I think, even if you are trying to, make the best of things. There's that small little bit of lack of control that people might not be aware is a thing that has to happen. So if you're, like, looking to bring in a bunch of income and you're really, like, you're planning for every ounce of that income, and then somewhere along the way, somebody didn't mention, hey, let's think of tax, then suddenly you don't have as much income because, you get to tax time and suddenly you have to pay installments quarterly and it's a total surprise. That could sort of throw off a person, and then that person will tell another person, will tell another person, will tell another person, and it'll just sort of, it compounds into something super scary. I feel like it's a lack of control sometimes. It's a major impact to your finances.
It's complex. Like there's a lot to know.
Yeah.
It's a full-time job to learn that. That's why there's accountants, I guess. But there's so much. So, like, it feels like a mountain of what you'd have to climb. So I guess maybe for clients, it would be a hard question to ask because there is so much behind it.
Yeah, true. And it changes all the time. Like there's always something new in the Tax Act, or there's some big thing that hits the headlines. Like a couple of years ago with the increase in the taxable capital gains, like that happened briefly, but then didn't happen. Yeah. Like that was huge in the news, right? Yeah. And it caused everybody concern and worry, right? So I think it is there's a lot, and there's a lot that could be picked up and talked about, and a lot of stuff might not apply to me, might not apply to you, might not be whatever, but you just don't know for sure. So it causes a lot of concern and worry. So I agree. It's a lot.
Yeah. So I guess it's just people feel intimidated to even talk about the subject because there's just, you don't know what the answer could be because there's so many variations to it, right?
So we talked a bit about this before, but what would you say are some common misunderstandings you see around tax efficiency?
Yeah, like two really jump to mind for me. One of them is RSPs.
Right.
Okay, so there's definitely a lot of talk out there around if people should use their registered retirement savings plans, RRSPs, right, which is an account where you put money in, you get a tax deduction when you make the contribution. Right. And then eventually when you start taking income when you're 72, you have to convert your account to an RSP by 71 at the latest and take your first payment at 72.
Right.
Then you start paying tax on that income, right? So a lot of people are saying, well, I'm in retirement now, and now I'm taking this money out of my RRSP, which has now turned into what they call a retirement income fund, a RIF, and they're having to pay tax on that money. And in some people's situations, it's bumping them into another tax bracket, and things are happening. Like they might get their old age security claw back, a pension that you get in Canada for living over 40 years is the maximum, and you get a percentage of that if you've lived under that.
Right.
But they think, well, should I have done those RRSP contributions if I have to pay tax?
Right.
Well, the reality behind that is that when we usually recommend people to save into RRSPs, it's because they're in a higher tax bracket while they're working, right? So I'm just going to pick a random number. You're in the 38% tax bracket while you're working. And then in retirement, a lot of people are dropped down. So they might actually only be in the 22% tax bracket. Right. So when they put that money into that RSP while they're working, they got 38% back.
Right.
From the deduction. And then when they're taking that money out later in retirement, now they're only paying 22%. So they actually made 16%.
Right.
But for a lot of individuals, they forget that part, right? So that's where the planning really comes in and where we can help, because there are situations with young people when they're first starting out where saving into an RSP doesn't always make sense because they might be barely making any money. Right. So that's when maybe we'll look at other accounts. But that's a really common one that we see all the time where people are saying, why did I ever do this? I hear this all the time. I should have just put in a tax-free savings or something, but they forget they got that benefit.
Right.
I really went on a tangent there.
So, okay. The one thing I think is important that we bring up, because, we joke about this, we say this all the time, is that we want people to pay as little tax as legally possible.
Right.
So, and we always, we're not joking. We do plan to be legal about the whole thing. But for some reason we feel the need to say it. And I suspect it's because when we think about minimizing, sometimes that means avoiding paying tax.
True.
And I just want to I think we should probably outline that a little bit, because when we think about tax efficiency, we are reducing excess tax that doesn't need to be paid. Right. We're not avoiding paying what we have to pay, because when we consider taking money out of the RIF accounts, or we are using our non-registered accounts for different stock investings or something to that effect, there are going to be taxable events that happen, but we don't avoid them. We just make sure that we have the right stuff in the right places at the right time.
Oh, this is my favorite.
So that when the event happens, we are able to reduce the tax.
Yeah. And you talked about this a few seconds ago, which is my personal favorite topic with clients, is asset location versus allocation.
Yeah.
So it's where are we saving money in what account
Right.
that's going to make the most benefits to our clients, right? And so often when we review clients' portfolios, so if we get investment statements from the outside, we'll look at them and very quickly identify, okay, well, they have an RRSP, but they're holding all of their growth, money-making money investments in their RRSP, and then their tax-free savings is sitting in cash or very low-performing investments. So we're looking at things like this because our tax-free savings account is actually one of the only accounts in Canada that the government gives us that we can make as much money as possible and never pay tax on that growth.
Right.
So when we're thinking about being strategic on where we place things, we want to place our money maker investments in there so that you're going to get the most growth, pay the least amount of tax.
Exactly.
Whereas our RSPs, for example, every dollar you earn in that account eventually is going to come out and you're going to pay tax on all of it. So that is kind of where we put a lot of our safety, right? So it's just building out our portfolios to be really tax efficient, right? So we're not avoiding, we're just minimizing.
Right.
Yeah.
A super important distinction to make.
Exactly. And so I guess, I mean, we're talking about questions clients ask, but I would challenge a lot of the clients out there to go ask this of their advisors and see what their strategy is around this, because I think it would be really helpful for a lot of people.
Yeah, I agree.
Okay, so we've kind of talked about tax, which of course is a favorite topic.
Right.
Let's talk about money and families. Okay. So we do get this a lot in appointments where clients compare themselves to others.
Yeah.
Especially couples, right? Because sometimes even a couple will have a different of opinion within their marriage, right? So the question here is, do other couples struggle with this too?
Oh, and the answer is like an absolute yes.
Yeah. How normal is it for couples to have money friction?
I think it's more normal than abnormal.
Right.
Like, I think we have more people that have some sort of friction than not. I do find, though, that there might be a lot of people who have grown accustomed and used to the plan that they have as part of their family, but almost always we see two people with different risk tolerances, two people with different values associated. Like, money to one person might mean security, it might mean prestige to another, right? In which case, that's a very different way of showing it. So the person who needs to have the security is not going to be the one who wants the 200-foot sailboat, or if they're even that long. So it's those things can happen within a relationship, and the trick there is sort of coming to a happy medium. But absolutely, I think that every single couple out there, there's not going to be, I mean, there will be, of course, but I think it's more normal for there to be friction than there not to be.
Exactly. And that's part of our jobs a lot of the times, is putting these two perceptions of money together within a plan, right? So it actually makes it quite fun for us, because we get to hear two different points of views and talk it through, and that's what's nice about our jobs, is we can build custom things and investment solutions that all work toward the same goal within everybody's comfort level, right? So
the best part is when you have a couple that is very competitive on their money. So they'll have their plans, and then they come in to the appointment and say, why'd so-and-so do better than me? Right, for whatever minute. We're like, wait, what? So we might have had a whole different thing, and then the competition level comes out. Usually that's just sort of a fun thing. It's not not anything really super serious, but that's always the most fun for me, when we're building around sort of what we see as sort of the pattern of the couple over the length of their relationship. And then they come back next time being like, wait a second, this person did better than me. And it's all sort of joking and good fun. But I do find that is a thing that we have to acknowledge when we're building a plan, and see how they're going to interact with each other, if there is going to be a difference in the investments. Because sometimes that's a very strong point that some people don't consider it as part of the whole household income. I think of it as, this is mine and this is yours, and how are we both going to make sure we contribute equally to the house? And those are things that we need to know.
And I guess this is great in terms of the question I wanted to follow up on, is kind of, how do you bridge the gap for partners who think differently about money?
It's a tough gap to bridge, really. If we go back again to the person who sees money as security, wants that money in the bank account or the investment account, and they're the ones who come in and be like, I have a goal of getting to this much money, and this is what I'm going to get to. Whereas the other person in the relationship might have a goal of half of that amount of money, and once they reach that, they want to spend it all. Right.
Right.
So those are really sort of those are dynamics that we really need to work through to get to a happy medium for both people. And it doesn't always mean that they wind up doing things together in
Right.
terms of their investments, right? We might have a plan for this over here, and we have a plan for this over here, but it has to try to work it all together.
Right. And I think of our role as kind of like we're not there to be referees
Right.
for the couples.
Yeah.
To give people a red card or a yellow card. I don't know. I don't really watch soccer, but I've heard about it. So we're not there to do that, but we are there to kind of help translate, right? Because we can usually, just based on our experiences from seeing different people and who have had different walks of life, we're usually able to be really good at identifying what they're trying to achieve and where they're coming from, and maybe being able to bridge the gap that way for the couples as well.
Yeah.
All right. So we talked about couples.
Mm-hmm.
Let's expand on that. Another question we get asked a lot is, are we doing enough for our kids? How do you answer that one? Or why do you think people bring that up?
That's a tough one. I mean, I think we all want the best for our kids. We want them to have the best start in life possible. And we can hear all of the, like you talked about inflation earlier today. We know things are more expensive. We know the cost of living has gone up. We know sometimes if people are looking for properties, they can be out of reach for some. And I know that sometimes home ownership is very, very important. I mean, if I'm speaking for myself from the lens of being a parent, I think there's if we think about the current markets that we're in, we think about inflation, we think about our kids' abilities to go to school, be able to come out of university without debt if that was possible, but university is so expensive these days. The idea of buying a house for some seems just insurmountable given sort of the obstacles in their place. I would say that the pressure is immense on parents to feel like they're doing enough.
And to provide.
And there's a super fine line between doing enough and doing too much. And that's the thing. We're all hoping that we're doing the right amount, doing the right amount for our kids. So maybe that's because we've utilized an RESP and we're, taking advantage of the government grants and such that come with our savings if our cash flow allows for it when our kids are younger. Maybe we're using that as sort of a way to subsidize our kids for their education if we can. If we flip this to a retirement perspective, how much can we help our kids while still helping ourselves? Like it just comes with an immense amount of guilt, I think, and pressure to make sure we're doing the very best for them. At least we hope that people are hoping that they're doing the very best for their kids without doing too much. And I think we all just hope we're getting it right.
And so as, if we put the lens on as an advisor, right, how do you help families sort through this conundrum, like enough versus too much? What are some of the things that we should look at?
Well, let's look at it from the perspective of retirement first, right? If we, that's a thing that comes up all the time. Should I gift my money now to my kids? Should I give them an early inheritance? Or let's say they get an inheritance and then they want to flow it straight through to their kids. It really comes back to that all important plan and looking at the numbers, because the numbers are going to tell us what's happening. There's nothing wrong with gifting your money to your kids if you are looking to, minimize the probate fees and whatever, and all that sort of stuff that comes with estate planning. But make sure you can take care of yourself first.
Right.
And I would say that, we sort of tip over to too much from, that hopefully middle road that we're getting to if we're gifting beyond our ability or our clients' abilities to be able to, live out the next stages of their lives in a manner that they are hoping for or have worked for this whole time. Now, of course, there's always all sorts of other sort of dynamics and things that come into play, different emergencies that come up, all that sort of stuff. But if we were thinking just sort of generally from a retirement perspective, and what our jobs are as advisors is making sure that, our clients who are retired for this sort of scenario have that proverbial like oxygen mask on, first, and that can stay on and look after their own selves, and then look at the gifting strategy from there, right?
We we just went through this exercise with a client not too long ago, and they were trying to figure out, well, how do I pass this on to my children, without them paying so much in probate, right? We sort that for people all the time. But what we did was we actually brought the client in and their children, and we sat them down and we said, look, here's mom's situation. And the reality is she wants you to be maximized for whatever it is. But we need everyone to understand that she also still has, potentially another 20 years, right? She's in her 70s, and there's going to be potential care costs there too. So it's great that we want to gift money now, but it's having everybody understand what we're doing and where those resources are going. And that if there is the ability to do both, that's great. But we want everybody to be on board with what's happening. So I think that's a really great thing for clients to think about when they're working with somebody, is maybe a family meeting could be super helpful in this type of situation with just understanding what's going on.
Exactly. And then what about, so I sort of alluded to like university and stuff. What would you say for like younger people with younger kids? Having a younger family can be incredibly expensive these days. How would you sort of bridge that?
Well, I guess just setting up any type of monthly contribution, if you can afford it, even, $25 a month into a registered education savings plan could be super helpful, right? In some provinces, there's grants that you can get for putting in $50. Like Alberta had one that was like $1,200. You put in $50, you get $1,200 for your children, right? So, I mean, it's just being aware of what type of grants are available for you in your province. And that's what as advisors can help with. And for very little amounts of money to get them started, you could end up turning that $50 into $1,250, right? And so that's just something to keep in mind, and just do what you can, right?
Right. Perfect. Sort of maybe one of the other questions that we hear from people, aside from, couples and kids and all that sort of stuff, is, so should we start simplifying?
That's a great question, and one that we get asked quite a bit, especially as people age, right? In the past, it was quite common because there's something called CDIC insurance, which was, insurance protection for banks or different financial organizations up to $100,000 per account. And there's different rules, but for today's topic, I'll leave it at that. But we would see a lot of clients who banked at multiple financial institutions, right? So they would have a little bit money at TD, a little bit at BMO, some at Tangerine, some at CIBC, and they would have financial accounts everywhere.
Right.
That becomes very difficult to manage as you age, right? Because it's multiple appointments, multiple updates to do. So we often find that clients get to an age where they don't want to do that anymore.
Right.
Or if they're having their children become power of attorney, or somebody, our close friend, become power of attorney,
then they don't want to do
They don't want to do that either. They don't want to be having a meeting with an advisor at 6 institutions, right?
Yeah.
And not to mention, if they were to pass away, how much work that will be for your executor, right? Because they're going through that whole estate process at every single one of those financial firms.
Exactly.
So it's one of those things where we often talk about, it does make sense to look at consolidating and getting things down to a more manageable volume for people as they age. And I mean, we have a really great concept that we use with clients, and it's a visual that we call our wealth map that we've built together over the years. And we try to capture all of the imperative information for that next generation or that executor today, right? So even if we do have clients who do bank at more than one institution, we try to capture it on a one-pager along with all of their team. So their team would be us, for example, or their advisor, or their lawyers, their accountants. We want to lay it out as simple as possible for clients so that if something were to happen, it makes it more manageable. And then somebody like us, who kind of acts like a general practitioner, can direct our clients as to the next steps, or the executors, right?
Right. Now, there's always the topic of redundancy as well. Right. One of our favorite things to talk about. Sometimes unknowingly, because advisors don't talk to each other from different institutions generally, unknowingly, you might be invested in all the same things. in
True.
all the different places. And some people are very concerned about not keeping all of their eggs in one basket, whether it's a CDIC thing or it's just something that their parents said to them back in the day. They think having all of their money with one institution might mean having all of your eggs in one basket. Except, even though they have different eggs in different baskets, those baskets are all the same investment.
Right.
So they've really not. They've really done, it's because nobody knows what the other person is doing, and when there's like that many different institutions, sometimes it becomes very difficult to keep track of, and then the redundancy is rampant in the portfolio.
Yeah, and often what I say is you're pretty much paying fees for the same thing at every different institution. Why would we do that, right? We should be paying for a fee and getting value out of it. And so therefore there's the redundancy in that as well. And if I know anything, nobody wants to pay more fees than they have to. Myself included.
Right.
Alrighty, so we talked about a lot of the hot questions that clients ask us, or might be a little bit reserved on asking. I thought it would be good to ask you, what's one question you wish people would ask, even if it's awkward? It can be from our list that we talked about today too, or is there another question that you wish our clients would ask?
You know what? We didn't actually talk about it. It's not on our list. But I wish everybody would ask us how we get paid. And I wish they ask what the fees are like and how that impacts their portfolio. Everyone should be asking. It is a question that is becoming more and more important as advisors with our regulations that we, showcase to some people. But we really should be having sort of, in quotations, I'm going to say that, fulsome conversation so people know exactly what it means. Transparency for your returns and what you're paying to get your returns is an incredible thing, and people should be asking more about that if they can.
Yeah, they should know what they're getting for what they're paying. 100%.
Exactly.
Couldn't agree more.
So if we think about, people, like if we think about messaging, what is a message that you think you would give to someone who thinks that they should have it all figured out by now?
I would say I don't think that's ever going to happen. That's my message for anybody, anything. I mean, when I first started in this industry 15 years ago, I said, okay, I'm just going to do this course. I'm going to do this course. But I mean, it's an ever evolving thing. There's always more to learn. And that's going to be the same for our clients too, right? I mean, it's just something that you need to have a good team that you can trust. I think that's the key, is having people you feel like you can ask these questions we're talking about to is key. Yeah. And then you can have honest conversations about it and be able to say, well, tell me more about that. Or what you say doesn't make sense, right? Like I need more clarification, right? So as long as you're surrounding yourselves by people you feel able to ask those questions to, I think having a team of professionals that can assist you throughout this journey is going to better equip you for whatever comes your way. But I don't think anybody ever really has it all figured out.
For anything. No, not just this.
Everything. No, in general.
Yeah.
We're just always growing, right?
Right. Yeah. So I guess we could say, if we sum this all up, there aren't any bad questions.
No.
Just only the ones that we don't ask.
Oh, I love that. And questions are the starting point of any type of financial planning we're going to do together.
Exactly.
We have to ask them.
Well, thanks so much for listening to and watching our episode today on sort of the questions that are important to ask, but sometimes people don't feel comfortable doing so. If there's anything that we've learned along the way here, is that it's really, really important that you work with somebody that you trust and you can ask these questions to. If this is something that you would like to chat with Joanne and I about, we're always happy to sit with you, get to know you, and offer suggestions as we can.
Feel free to check us out on Spotify, YouTube, or our website at islewealth.ca. Thanks again for watching. Bye for now.
Corporate disclaimer. This podcast has been prepared by and with expressed opinions of Joanne Kaban and Melissa Maguire, and are not necessarily the opinions of Raymond James Ltd, RJL, statistics, data, and other information presented are from sources RGL believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for informational purposes only and should not be construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making an investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions and/or issues in these areas, please consult a legal, tax, and/or accounting advisor. RJL is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. advisors may only conduct business with residents of the states and/or jurisdictions in which they are properly registered. Raymond James USA Limited is a member of FINRA and SIPC. We hope you enjoyed the podcast, and for more information, please visit islewealth.ca.